Hello and welcome to the Rose Snyder and Jacobs webinar series. I'm your host, Jessica Leitao. I'm a tax manager here at RSJ, and today we are going to be talking about ways to not get audited by the IRS. I have my very esteemed colleague, Anna Kasheshian, here with me today. Hi, Anna.
Hi, everyone.
And before we start, I have to brag on Anna a little bit, and she told me not to, but I'm still doing it. Um, Anna comes to us with a wealth of experience from working to local and national size firms. She has a specialty in nonprofits and as well as with individuals, high net worth individuals, and their family groups. So everything. But we're going to emphasize the nonprofits and the individuals. And today, Anna, I think we're going to talk about all of the issues we've seen where we could have avoided or people could have avoided really flagging their returns for audit. Sound good?
Yes, thanks everyone for joining. First of all, Jessica, thanks for the introduction. It takes one to know one, so I'm really glad to be here and to um, give off my knowledge, even though it's not much, but I'll try my best.
Says every humble brag. All right. So today we're actually going to start, as long as it's okay with you, with the individual side, kind of work our way through where there could be a melding and then get into businesses. Does that work?
Of course.
Awesome. Okay. Um, on the first to-do list, what I think we all talk about, and one of the major things that can flag an audit, especially when it comes to individuals, is failure to report income. That's always what you hear, like, oh, fail to report income, it's an automatic notice, an automatic audit. What does that really mean? What does that consist of? How do we avoid it?
Failure to report income can come from many, many sources. First and foremost, I think that people miss is getting a 1099 for contracted labor, for outside services, for any sort of payments over $600, and you don't report it. That is the first, I think, audit or first notices we've seen coming in. Second is from broker statements. So you have an account with Charles Schwab, you have a little bit of interest and you forget to report it, or you get the 1099 sometime in February, you don't know where you put it, you forget to tell your accountant, you don't report it. So that's another area. Another one I think is the K1s. So you have partnership in an S corp or a partnership, sorry, investment in a partnership, and you don't report the income flowing through to you. I think those are the major areas we've seen. Jessica, correct me if I'm wrong, but yeah, failure to report those can be hazardous to you.
Yeah, and I think I want to step back and talk about one of the first points you made around the 1099s. I think there's some confusion there, what actually has to be reported and why it's important to report those 1099s. Let's separate out between like a regular, like maybe an NEC and a 1099K, and maybe how that ends up working on the individual tax return.
Of course.
Yeah.
A 1099 NEC or MIS is services you provided to somebody, anybody, or a firm, company, and they pay you if it was over $600.
For business
Um,
expenses, yeah.
yeah. 1099K is reporting you get for credit card transactions. So if you charge anybody over $600 or transactions that add up to $600, your credit card company has to send you a 1099K, which means you receive this much in income.
I think with what we've talked about before in a different webinar is the 1099s are, therefore issued to the IRS and our state jurisdictions. So this failure to report income sometimes really what ends up happening is they already have the information and they're waiting for you to report it.
Exactly.
So
Yeah, it's a
yeah.
matching technique, basically.
Yeah, and I think everything we talked about. So we have the 1099s, you talked about the K1s, and the 1099K, all of those things are already reported. So when the IRS is looking in their database, and tell me where if I go off track, the IRS is looking in their database, they already have where they think your income is, and they're waiting to see what else you provide in terms of expenses, in terms of additional income that they may have not received a 1099 for. Is that usually what's going on?
Yes, that is the case. Like I said, it's the matching technique. They already know it. They're just waiting for you to report it. And with everything getting so intrinsic with the computer systems, and they've been updating their systems and hiring so many more auditors, it's bound to catch up. So it's just a matter of time, and they're waiting for you, basically.
Sounds scary.
Not at
Um,
all.
I think what I do want to touch on before we go move on to anything else is we have, cash businesses. So sometimes we have these businesses that maybe are not uh, services provided. Maybe they don't fall into 1099s. What happens there? How does that kind of work if you have a ta cash business and you're failing to record the income?
That gets really tricky because you have a cash business, you only report half of it, but then you have the fancy cars you're driving, the fancy house you live in. Your car is registered with the DMV. Your house is registered with the state, the county, and it has your social security as the purchaser and all the fun information. So going back to saying where computer systems have become so intrinsic and so smart that all the government agencies are interconnected. So if you don't report on one, it's bound to catch up on another system and come back to you in tenfold. So it's like I said, it's just a matter of reporting. And when you report underreport cash, you are you're at a higher risk of getting audited because they look at industry standards. So if you have a grocery store and the grocery store next to you reported 100,000, you're only reporting $10,000, it's gonna trigger an audit.
And I think we'll touch on this later, but I think you say this, and I want to emphasize this. The government agencies are interconnected when it's punitive. They're not so interconnected when it's helpful. And I think that we've all dealt with that. The IRS knows something and they've been fine with it, but for us in California, the FTB may not be as quick to catch up on it, and you kind of have to plead your case. But the moment it's punitive, everyone knows. So the DMV, the
100%.
county, the FTB, the IRS, everyone gets
Yes.
there. So just kind of keeping that in mind as we're going over this. I don't know that the government's out to get us, but they are very communicative when there is an issue. So,
Yeah, I wouldn't say they're out to get us. Actually, I was going to mention this. Audits or red flags always scare people, but it's really not. It's basically you get a notice and they're telling you to correct it before we find anything else or
right.
before we send you what we think you owe. So if you respond to the notice, you have a CPA, you have us, you just send us the notice. We'll take care of it with one letter. Most of
Yeah.
the time, that is how it works, unless it's really, really deep, unless it's fraud, unless it's other
Things we don't
aspects
like to
involved.
discuss as much. Yes.
Yes, that's another topic for another day.
Yeah,
Um, yeah, for the most part, it's really not that scary, but it happens more often than you think, and you just respond to it.
totally. So before, as we move on from failure to report income, I think it kind of directly goes into on an individual, the Schedule C. So we have Schedule C, we have the income that we're supposed to be reporting, and then we have Schedule C losses. So let's talk a little bit about Schedule C losses and how those can be huge indicators that something is not as it seems.
Not kosher. Um, We see this more often, I think, than we'd like to admit. We have clients that are starting a business. It's a gig economy right now. Everybody's an Uber driver. Everybody's delivering something, so they're trying to claim as many expenses as possible, but as little income as possible. So it's kind of trying to offset your other income that you're getting. But if you keep reporting losses, it's going to catch up. The IRS is going to say what's going on, and it's going to be classified as a hobby loss. We'll get to that later, but basically, again, going back to looking at industry standards and what the average Uber driver is reporting as opposed to what you have reported will trigger an audit.
And I know we'll talk about hobby losses in a little bit, but maybe we should kind of touch on what makes it so that you have to report on a Schedule C. So what makes the business, like what is it that drives that Schedule C forward that you're like, actually, this is a business, this is something that you need to report in terms of income?
All right. So it's the profit motive. What are you in this business for? Are you in it to earn money, or is it going to be just something you do for a little bit just to catch up with your expenses, with your cost of living? Really, Schedule C can only be claimed for people who have a profit motive. You intend to run this for remainder, the next couple of years. You are actively advertising, you are actively seeking clients, seeking sales. You're on social media posting and wanting clients and needing more business. You are meeting with clients, you're taking the initiative to go out there and whatever your field is in your networking, marketing, and so on. So it's the
Yeah,
motive here.
getting the right licenses too, really showing that this is legitimate. And I
Exactly.
think we've seen an uptick in notices concerning Schedule Cs, and again, we'll get into hobby losses, but we've really seen an uptick in Schedule C losses. Um, I've particularly dealt with just even a notice of, hey, we saw that you have several years of Schedule C losses. If this is correct, leave it and we'll get back to you with our findings. If it's not, please correct it. And I mean, that's kind of a weird letter to get, but realizing that people are really starting to look with a microscope at how people are offsetting their income.
100%. It's just, I think the tricky part right now, and maybe the next couple of years, is because the economy is so bad, it is going to be common to have losses. But
Right.
again, careful or good record keeping is so crucial so that you can prove, because burden of proof is on you, it's not on the IRS. If they
Hmm.
say it's wrong, it's wrong. They're not going to come and tell you, oh, maybe
Maybe.
you maybe, yeah.
What do you think about this?
Yeah, but if you have your records kept straight, you have a bookkeeper, you have your receipts, you have your income on valid 1099s and so on, you can obviously prove, yes, you've had a loss. But for the most part, I think the most important aspect here is record keeping and um, yeah, record keeping.
Record keeping, yeah. I think, and also just consulting, like if you have questions on whether expenses are valid or not. I think with our Schedule C and what people and the IRS and other jurisdictions are most concerned about, and tell me if you agree, I think a lot of the time they're concerned about the validity of what you're expensing. So, and I think we'll get a little bit more into this with the businesses, but are those travel expenses for you? Are they valid? Are your consulting fees, if they're all to your family members, are they then reporting on their Schedule Cs? So again, like I think there's a fine line to kind of walk with all of this. That's the IRS. May not be quick on the uptake, but once they get there, they're quick on finding the
One.
problem. Yeah.
Exactly. Yeah.
And we keep mentioning hobby losses. I think at this point, we should probably talk a little bit about the difference between Schedule C losses and hobby losses and what's really going on there.
Yeah, the number one example I think everybody has heard of is, horses. You got into horses, you love going riding, and you buy one, and then you start reporting it as a business. It's not, for the most part, horse breeding, horse racing is not considered a business, but a fine line to walk in. I've seen it with official businesses, but for the most part, if you try to claim the expenses for upkeeping the horse, and you just show no income from racing or breeding, then it's going to be considered a hobby loss. Hobby loss will get triggered by the IRS if you keep reporting losses for consecutive 3 years. Another example we've seen, Jessica, and you can validify me, is exotic cars,
Yep.
vintage cars. People buy those as a hobby, as
Collector's items.
something, collector's items,
Hmm.
and then they try to claim the expenses from upkeeping the car and repairs and paying for tickets to go to shows,
Right.
traveling for shows, and then there's no income derived from it. Basically, you're trying to claim the losses against other income you have, and that will be considered hobby losses. IRS will catch up, and once you get audited, it'll negate the loss you reported. So you'll end up paying a hefty sum for interest and penalties and the tax you avoided.
And I think what you talked about earlier just has to be emphasized for the hobby losses. It really comes down to profit motive. So are you doing this for your enjoyment and the enjoyment of your family, or are you doing this to actually earn money? And that can change, right? Like maybe you start off it's just being a hobby and then it ends up being a business, which, that can happen. And I think that's
Yes.
valid. But I think we've talked about this, and I think there's um, a couple that are interesting to remember. So vacation homes are one that you have to kind of like tread the line with. Like, are you going to actually claim that as income, or is that really just a hobby that you're taking losses on? And art. I think art is one, and airplanes. Do you have
Airplanes is a big
airplanes
one.
is a big
Yes.
one? Yeah,
Private
people.
jets.
Yeah.
Hmm.
How are you using that? What is it really used for? And I think it goes back to what you're talking about for Schedule C. It's meticulous record keeping. And also remember, the IRS has such a huge pool of people to kind of look at the trends. So, you may be saying, oh, this is actually, a Schedule C loss. This is where it's going from. But they have years and years of history on tons of different people that have tried different things. So again, the burden of proof is on the taxpayer or as their representative on us. Uh, but we're dealing with someone that has a vast amount of information and sample size to look and see what we could be saying or what we're doing. There's probably not a lot in terms of hobby losses and Schedule Cs that the IRS has not seen before.
Yes, and even we have seen it being in the business for so long. People try to claim so much, but there's only so much we can do to prevent them from getting audited. And I hope um, the clients see that as, us trying to prevent them from going to the next level with the IRS.
Right,
The other thing I wanted to touch on is on a Schedule C, you have a valid business going on, and let's say you're in LA. LA is notorious for coming after you for a business license. So if you're operating in the city of LA, county of LA, you are required to obtain a business license. If you're running a valid business, I'm sure everybody that has the correct or the right CPA will tell you get your business license.
right.
If you're doing this for a hobby and you don't get a business license, if the IRS doesn't come after you, LA will. The city of LA will come after you and say, hey, you've been operating a business. We saw you have a Schedule C. Where's our money? So it's kind of a catch 22 with all these government agencies. If one doesn't catch you, the other one will. It's the counties that you report your business property taxes. It's the franchise tax board. It's the IRS. It's just so intrinsic and interconnected that something will catch up eventually.
I think we will talk about this too a little bit later, but for Schedule C especially, I think that we had a lot of people at one point, especially being in COVID, we had the opportunity to be on YouTube and TikTok and all sorts of social media. I had a bunch of people telling us like, hey, just open a business, start a Schedule C and like run XYZ house expense or run XYZ car expense through it, only show a little bit of income and offset it. Uh, and that has been tried before. It may not have been tried with leasing a car, but I think in the last 50 years, people have tried to come with really creative ways to do all this. And I think what you also touched on is I have encountered not, fortunately, not a client, but a person who actually pretended to run their business. So they like had business cards, they did all of these things, but at the end of the day, it wasn't, and they were undergoing an audit. And they asked like, "What are my chances?" And I was like, "Well, you faked it really, really well." But again, it was lacking that profit motive. At the end of the day, the IRS is going to be like, "Well, were you doing this for you to make you happy, or were you doing this to actually make money?" So they ended up actually failing that audit, and it was reclassified as a hobby loss, which was it was exotic cars, so it was not a great turnout for them.
Yeah,
And I
I've
think about
seen
going,
that often, actually.
yeah,
More often, again, like I'd like to admit, but it happens so much with Schedule Cs that it's unavoidable at this point.
right. And again, it's just as you said, like keeping those records, making sure you're consulting with your CPAs before you're jumping into a business venture. Or, again, I think we have such a wealth of information at our hands to lean on in terms of social media and anything you can look up anything on Google and figure it out, but that doesn't necessarily mean it works for you. So I guess this is our cautionary tale for Schedule Cs, but continuing on this working from home and Schedule C track, I want to talk about the home office deduction, which is probably something that makes me the most nervous. Can you tell me more? What makes it valid? What really raises a red flag? How does that work?
Again, with the standards now, or industry standards, or social standards right now, everybody's working from home,
Hmm.
or for the most part, most people are working from home. They're trying to claim home expenses as a business deduction or part of the home. So what happens is we'll ask you, well, what part of how much square foot is used for your business versus how much is the whole house, the square foot of the whole house. And then once you provide that, then further on, we'll ask you more questions. Is it exclusively used for your business, for your work? Is anybody else using that area? Is it in the TV room where the family also enjoys? Is it in the kitchen where
Right,
the family dines? And it might be intrusive, but trust me, the IRS will come and ask you these questions as well. And for the most part, if you try to say, yes, kitchen is exclusively used by me, it's gonna be like, I don't think so. It's a family
right,
area and everybody comes and goes through it, uses it at some point or another. Um, most I've seen it happen where people convert one area of the house exclusively for office, which is totally valid, and you can write off your utility, part of the utilities, part of the mortgage interest, part of the real
right.
estate taxes, and whatever other expenses you might have for the house. But the motive here again is, are you just trying to get extra expenses, or is it really used for your business? For example, are you meeting clients at home?
Right.
Are you using, or are you going to the office to meet the clients? Or are you traveling in order to meet clients? It's just, um, I think, a bunch of questions that will eventually trigger what your intentions were with the home office deduction.
I think there's something that you touched on, and I want to kind of emphasize here. You said exclusively, and I think regularly, right? So those are the two main
Right.
words that come to home office. And I think we had Alan, a partner here, talk about this, and he says, you get your interest expense on your Schedule A, and although your property taxes are limited by SALT, is it really worth the IRS looking into? Like, can you actually prove that there's really no other use of this space? Um, I think we talked about this a little bit. There was an example you gave of therapists, right? So how would you say that a therapist kind of really has the opportunity there to use the home office deduction?
Yes. Again, going back to standards now, or the social standards at the moment, because everybody, a lot of therapists are doing telemedicine now. Their patients don't want to drive out to them anymore. They're comfortable with the Zoom their sessions, and therapists tend to have that exclusive area because they close the door so that it is private. Obviously, they have that patient privacy laws. So those are valid. And therapists, I do have a client who's a therapist, and whatever home expenses she's getting is totally valid to deduct. But again, it goes back to what your motives are and what the standards are for that, for the field you're in, for the business you're in.
I think there's something we should probably touch on here too, the difference between a Schedule C and an employee working from home. Because I think there's that confusion that comes up quite a bit.
It does. My favorite one is they lease a car and they try to write it off as a business expense, but then they're working from home. Well, where are you driving to with the car you leased? You're trying to
Right.
expense as a business, and employees get a W-2. um, it's very hard to prove that you're running a business as a W-2 employee
Right.
because your employer will provide your computers, your equipment, your gear you're using for work. So it's very, very hard to prove as a W-2 that you are running a business from home and you can take the deductions for home business expense.
Yeah, and I think really what I've heard a lot of, especially again, all of my friends work everywhere. I have friends that are in Europe working and they're talking about home office deductions, and you got to just think about this from the IRS's perspective of if you're traveling a lot, if you're meeting clients outside of your home, if you don't really have a home that you are attending and working from, and you are an employee, this is not the deduction for you. This is really for those people who have converted their houses. I know hairdressers that converted their ADU into a salon. Those specific intended uses just for those businesses. I know that there was um, a personal trainer who converted his garage to a gym, to a home gym, and he wanted to take a ton of deductions for that, which he's not a client. But what was interesting, what his CPA told him, and I kind of agree with it. They're like, well, how many clients are you actually training here, and how much are you using it for? And so he was even looking with a microscope at that, just because, again, as you said, everyone's trying to get those Schedule C deductions for things that they enjoy. So you have to really be careful. And I think the home office deduction has traditionally been and will continue to be one of the hugest red flags for an IRS to look at, or any jurisdiction.
Yes, yes, it does.
And I think also, just to add on to this really fast, people have to realize that all of the information of your home that you own is available. So again, going into that square footage conversation and location, they can look at that pretty easily and understand whether or not you're really using that area as it's intended for the deduction. So
It's to Google Maps. Yes,
to
everything is
Google
out
that.
there.
And kind of touching on a point I was like making a little bit earlier about traveling and getting your deductions that way. Let's talk about foreign bank accounts. The touchy subject, it gives people anxiety, but let's talk about how what flags are raised by having foreign bank accounts and how you get there. Mm.
Again, it's our economy now. It's the global standards. Everybody's everywhere all at once. It is not uncommon to have a foreign bank account. I'm a foreign, I was born in a foreign country myself. I visit there often. Um, I don't have a house yet there, but I plan to buy one. And when I buy
Right,
one, I'll open a bank account there. So it's like, um, again, with the interconnection, you're transferring money to and from your bank accounts,
right.
in order to pay your house there, the expenses there. And the bank is required to report those transactions to FinCEN. FinCEN reports to the IRS. It catches up to you, even if it's $2,000. We always tell our clients it is not worth not reporting it, because the fees for not reporting foreign bank accounts and foreign properties is hefty. It's a lot. $10,000 is the starting, and it can go upwards of $100,000 in fees and
Well, yeah,
penalties.
it can go into half the value of your bank account.
Exactly.
So let's
It's
not do that. But you touched on it a little bit, talking about reporting to FinCEN. I think we've talked about this. You have a sister that works in that area, is that right?
correct.
Yeah.
Yes. And her job is exclusively to watch transactions going in and out of foreign accounts. How much per day? Where is it going to? What is it being paid for? And then boom, once it triggers something, she reports to FinCEN. And again, it's
Yeah,
catch-all.
and I think as you said, we live in such a global economy, and if you are reporting income from a foreign source. Outside of brokerage statements, let's not get crazy. Outside of brokerage statements, if you're reporting any type of income, they're kind of, okay, well, do you have a foreign bank account? What's going on there? How are you doing that? And then it pulls into, where are you living? Where's your address? Are you not, are you avoiding taxes, paying taxes here by saying you're paying taxes elsewhere? It really all just trickle effects by one number and one payment of you reporting or not reporting. So
Exactly.
again, I
Yes.
think uh, and as people may know, and you've touched on this as well, this is a different government agency that we're reporting to. That's FinCEN. We've talked about this in a previous webinar with the Corporate Transparency Act, and they are more involved with Homeland Security. So again, you're now dealing with two different agencies communicating again, and those are letters you don't want to receive. The FinCEN is probably where I would draw my line of just do not want to deal with that.
Um, I hate to admit it, but we have had clients with that Homeland Security coming in and trying to get your records. So avoid it. Do
Yeah.
not call us.
Yeah, no, that's not true. We
It's
can help you, but it will be
it's
stressful. stressful and
It's not
avoidable.
only the penalties you're paying to the agencies, but it's also the fees you're paying for accountants and lawyers in order to have your back. And is it really worth it for that $50,000, $60,000
Right.
dollars that you're trying not to show?
Well, and I think again, we continue touching on this, but we, as our technology for all of our businesses and work has increased, so has the technology for the IRS and for all these like reporting jurisdictions. So when we talk about matching notices, when we talk about all of these things, they now have software that says this Social Security is reporting this. Where is it on this side? Is it corresponding? Where are we missing something? So again, we do have auto notices, but they're running these through massive, massive AI technology to really get to where we are. And talking about running things through technology, let's talk about round numbers.
Our
Because I think,
favorite.
yeah, round numbers. I think that's one of our, as accountants, biggest touchy subject of talking to a client. So let's talk about that a little bit.
Yeah, it happens more than I think people realize because they don't remember how much they paid in property taxes, so they round up to the
Right,
next zero or the five. They do same with mortgage. So you have your Schedule A showing your contributions, your property taxes, and your mortgage interest, all with zero, ending zeros. Ding, 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 ding. It's, like, okay, what are you trying to do here? Because you get statements for those, and the statements are almost never round
I don't
numbers,
I don't know
never
that I've
rounded to
ever
the first
seen.
bit. Yeah.
Yeah, yeah,
Again, with the matching, that you have your mortgage statements, the bank sends you a 1098, you have your property taxes, the county sends you the amount you owe.
right.
It's on the statement itself, and it's not going to be round numbers. That's, I think, first area we see round numbers. The
Right.
second is on Schedule C. They don't remember how much they paid or how much expenses they have, so they try to round up, guesstimate, and give us the amounts in numbers ending with zeros. Not going to happen, guys. Try harder.
Also,
And
yeah, try harder.
this goes back to record keeping. If you had
Right.
QuickBooks, which is $50 a month, and keeping your records straight, you wouldn't have round numbers.
That, and I
Um,
think I see this a lot on Schedule E for rentals.
yeah.
But not even your personal stuff. Maybe you have your personal stuff in order, but the rentals is like, I made like $100 that month, and it was now we come to the end of the year, and I'm like, so everything is equal. There's no dollar or $3 or $2 or $7, nothing. You know, I think that's where
Yeah.
I see it the most too. It's like, and again, I think all of us have fallen victim to throwing that receipt away, not really wanting to put the work in and going through all of your bank statements. We've all been there, us included. I mean, even for me, I get frustrated when I don't have the information. I should have taken a picture, whatever it was. But as you said, it's completely worth the investment not to go through an audit and have it all opened up.
Yes.
And
Agreed.
I think before we get into anything else, as we've scared people sufficiently at this point, let's talk about where the audit limitations are a little bit so we can kind of get on the same page as to who really is being looked at.
It's not who really is being looked at, is the chances
Okay.
of getting audited increase as your income increases over $400,000. And then again, higher chances as it's over $1 million of income.
Great. So I think and I cannot remember the exact statistic, but I think that the percentages of being audited, like an income audit, are very minute, like probably less than 1% if your household income is under 400,000. Now you can be audited for other things, but like specifically looking at your income, I think it's less than 1% under $400,000.
Yeah.
Okay, great. So let's move into that muddy category of where people, individuals and businesses both try to, I don't want to say get away with things, that's not the right word, but where that areas of
Try to get
microscopic.
as much
Yeah.
as possible.
Yes. And we're gonna start with charity because I think charity is a place of debate.
It is, and people try to, again, take as much advantage as possible. You contribute to a church, you contribute to Goodwill, the local Boy Scouts, and what have you, and um, you forget to keep your receipt.
Right.
So you guesstimate instead of your $100 deduction, you say, it was around $300. Um, Charitable organizations have to send you a letter. Once you contribute money to them, they send you a letter saying, thank you for your donation of this much. Um, that does not go to the IRS, but if you get audited by the IRS, you have to burden of proof again. You have to show your receipts that, in fact, you did contribute as much as
Right.
you claimed on your return. Um, there's that, and then there's the other aspect of people contributing goods to Goodwill, to the local thrift shop, to um, cars are
Right.
common.
Yeah.
Um, how much are you putting in as the value of your donation? A lot of people think it's the cost they paid. So they're moving, they donated their TV and fridge to Goodwill. They paid back in 2007 $7,000 for the TV, and they think that's the contribution they get, but it's not. It's how much that TV is worth today. Probably $200 or maybe
Right.
even less. If you're contributing cars, which happens a lot, this is what we've seen. Um, you have to have a valuation. So anything you contribute that is worth over $5,000, you have to have a valuation for. Um, and correct me if I'm wrong, Jessica, but these valuators are so common. You can take it
Totally.
to the local, I think, where they sell use jewelry. I forgot the name, and
Pawn shop.
they'll they'll it's very, very easy to obtain a valuation for the item you're donating. So I think it's so worth it to pay that $100 if you're contributing goods over $5,000 in order to have that letter and the form correctly filled out for you so that you could give to your CPA for the validity of the contribution.
I think with also with charitable, if you're working with the charity, they'll find ways for you to also get those valuations because it's, in their benefit
Yes.
as well.
Yes.
Um, and I've had this a lot, and I think you've probably had it too, where maybe someone contributes $50,000 to go to a gala event, and they're trying to deduct the whole 50, and they get a letter saying it's not. Could we talk a little bit about that?
Yes, we're in the capital city of these galas happening. Um, Most of the time they spend so much money on these galas and they collect obviously a lot more, but because they're spending so much, they're gonna tell you you contributed $50,000, but your tickets were worth $2,000. So your deduction is only $48,000. I know for somebody who's contributing so much money, that doesn't make a difference, but on the receipts, you do have to pay very close attention to how much your exact contribution is when you attend performances or galas, dinners that do provide something in order for you to be there, whether it's dinner or entertainment or auctionable items. So be careful of what your actual contribution was on the letters.
And I think one of the main points with the charities is that you are not receiving any goods or services in return. So people also, I've had some people being like, no, I did that. And I was like, right, but then they gave you this, or like you saw this, or you're getting this benefit. So it's not really a charitable deduction, even though it may be to a charity. So kind of really looking into what you're doing is great. And then Anna, something else I wanted to touch about, and this is probably a topic of hot debate with everyone and their tax accountants, is GoFundMe.
I love GoFundMe receipts we get. Um, you saw your friend posted they needed medical bills for they needed to pay medical bills for
Right.
a close relative. So you contribute $50. They bring that to us and say, well, I donated. Well, good. I'm glad you're helping somebody, but GoFundMe donations are not tax deductible.
And I think what that really goes into is understanding the difference between gifts, which is a whole nother area that we're not going to be talking about on this call, gifts and charitable deductions. In order for it to be a charitable deduction, it has to go to a registered charity, and it's a 503C, right? Is that the right one?
Correct.
Yeah.
Yeah.
A charity. So there is a specific designated organization for those to be accepted. And for anyone that works in that realm, there are charitable arms of businesses. And just make sure that if you are going to be doing that, you are giving it to the charitable arm of whatever foundation or organization you're working with, and not just to like writing a check and hoping it goes out. And I've had clients who have not worked well with the charitable director, whoever it is. And in the end, the way that the money got transferred was no longer a charitable deduction because it went through a ring of things and didn't actually come from them. Um, Kind of like when you don't do the donations at your local grocery store. Those aren't actually your charitable deductions. They're the large corporation that you just
Yes,
rounded up for. Just as a
exactly.
little plug right there for how much I don't like this. Moving through, that both the if gray space between individuals and businesses. Can we talk about real estate sales? And we talked about this a little bit about how much the counties talk, but let's see how that can be a red flag for an audit.
Can we not talk about
We can, we're going to.
um real estate laws and tax are so complicated. I think we barely even have our heads around it without them changing anything. But um, oh my gosh, real estate is so tricky. We have a lot of clients that come and say, "Oh, I invested in real estate and I want to take a deduction, or, I'm having losses from it." Great, it's fine. You can have losses, but going back to the motive and how much you're really putting in that investment is what really the IRS will look at. Um, Real estate has classifications, or for tax purposes, are you active in it? Are you materially participating in it? Are you a real estate professional? Some
Right,
people will have, let's say, two rental properties, and then they'll say, well, I am a real estate professional because I have these two. But you also have a job, a full-time job you're running. Then they'll say, well, I'm a real estate agent, a real estate professional. Great, but can you prove that? Going back to keeping meticulous records of the hours you spent managing these properties is so, so crucial. Um, it has happened. We have seen it a lot where the clients get audited for claiming a real estate professional and deducting all the losses from the real estate business, but then they end up not being classified as such according to the IRS because other factors are at play here because they had a job or they weren't even in town for the
right.
amount of time they say they were running the business. Do you have a property manager doing all of those things for you,
Right.
even if you're trying to claim the real estate professional? Again, it's how involved are you and what the motives are for you to claim the real estate losses,
And I think I want to
rental
step back on
losses.
that, right? So just really quick, as a background on this, claiming that you're a real estate professional allows you to deduct those losses as an active business. So you're able to deduct those losses versus being classified as a passive loss, which we get into a little bit more later. Um, but I think what you're saying is totally true, and it's a huge area, especially in places like where we're located in LA. I feel like everyone has a family member that's in real estate, including my own. And as you said, the burden of proof is on you. There are a lot of apps for people that are going into this to really help them keep their records straight and being meticulous. Please keep in mind, and I think this is something I want to impart. If you have a full-time job, you are running another business, this is what you're doing. In order to claim those losses and really have rental losses, you really need to make sure that those are valid expenses. There's no bleed over between rental properties. Everything really needs to be kept straight and organized for that specific location as you do report per house, I guess you should say, or building or whatever you're renting.
Yes. Like you said, we all have somebody that is a real estate agent. So I know the agents I know, or some of them, most of them I know, they do keep actual mileage. They have an
Yep,
app where they're traveling for the miles for in order to see the properties and list them for open houses and what have you. So again, it's how involved are you?
right. And I think on that same real estate line of thinking, can we talk about real estate sales? Because I think this has been an area for both businesses and individuals that can get a little bit tricky.
It can. I think what we see most often is people um, not claiming, saying the cost of the house was worth more than what they actually paid for it because they don't remember it. They lost their escrow statements 30 years ago and what have you. I think that's the most common area we've seen of
Right.
clients getting audited is um, over exaggerating the cost of the property they bought. Another area is over exaggerating the expenses or the repair costs they paid in order to upkeep the house or enlarge it
Improve.
or,
Yeah.
yeah, improvements. Um, the other area is, again, I hate to touch on it, but it's the 1031s.
Hmm.
What happened with your 1031 exchange? This has become stylish way to
Yeah.
get rid of your real or sell and exchange your real estate. Um, in that case, the IRS will look at, well, did the seller get any cash? Was there any cash involved at all in the transaction? Because with the 1031, as complicated as it is, it's, property for property.
Right.
And there's really no cash involved. But how long was the property held for? Was it identified in time? It's all these factors that play such a big role in making sure you do the correct 1031 exchange by the laws, by the books. And there are, again, people that are experts on it. So our hope is that you are seeking the right help, the right
Right.
CPAs and the right agents that will help you with the doing it the correct way. Um, I think the other area we've seen is with the FTB.
Yeah.
FTB audits property sales often as well because when you sell a property, or the escrow company has to withhold um, has
A
to
percentage.
withhold, yeah, taxes for the amount of the gain or the
Right.
estimated gain. And you get a statement with your social security on it, your EIN if it's an LLC. And again, it goes to the matching theory here. You get 592B that has real estate withholdings, and it's the estimated gain. Well, you do your taxes, you underreport that gain and it triggers an audit with the FTB. And that's
Well,
really how it comes down to it.
and I think also this, especially talking about California, because as we are California-based, both of us, it's for those people that are moving out of state as well. So maybe you no longer are a California resident and you are, you've been in a new state for a couple of years and you're finally selling that California property. You have exposure there in order to report your income to California. And you will best believe that they will be coming after anyone that they feel is trying to withhold any type of taxes from being paid for California. So it's
Yes.
no longer just reporting it to the IRS, getting your capital gain there. It may go all fine and dandy with the IRS, but making sure that your local jurisdictions don't open you up for audit. And I have, a lot of people, a lot of our clients have been moving across the United States away from California, and we're really grateful for those cross-country clients that we continue to service. But I think what we have seen a lot of is California is still reaching into, well, you still have a house here. Are you renting that house? What's going on with it? You still have this, like, what's going on? And really making sure that you're properly keeping your records of that. But especially when it comes down to the sale, reporting it and reporting it in the jurisdiction that it happened is really, really crucial.
FTB will be on you within 2 days of you filing your tax return
Yeah,
saying, where is our money? Because that's the number one notice I see. Like
right.
immediately after we file a return with a client that moved out of state and didn't file in California,
Yep,
you still have your driver's license in LA. You
yep.
didn't change it or you forgot, and things happen. You forget to do it. You are still registered in the city of LA, the county of LA. With the going back to everything being so interconnected, it catches up way, way, way sooner than you think.
Yeah, and I also want to touch on that too. We have our own partner, Tony, who is Las Vegas based now, and I think there's been a lot. He had to go through a lot to make sure that his residency was legitimate because everyone from California is moving to Vegas or Texas, it seems. But they'll go down to even your dentists and doctors. So they when they try to do a residency to prove residency elsewhere, I mean, you have to really, when you're leaving California, be sure because they will quickly pull you and say that you're still a California resident and some of their money needs to come back to us.
Yep.
Um, Moving along into like that business area, because I want to make sure that we're touching a couple of these points. We've taught a lot of this kind of goes towards businesses as well. We talked about charity, we talked about your real estate, but I really want to start talking about areas of exposures for business expenses because I think this is something that we see quite a and especially as the trends change for the type of investment vehicles you're using, I think we've seen a really big uptick in LLCs in the last 10 years. There was a huge surge of S corps. We have our C corps, and we've had, as everything comes into style, so do the type of businesses you own, and understanding that each of them have their own complexities. A lot of people in LLCs don't realize that as a partner, you really shouldn't be taking wages, and those look different and they're taxed different if you are. So let's talk about areas of exposure there.
Um, Again, it's ordinary and necessary business expenses you're taking. It's the industry standards. It's the economy standards. Everything has changed so much, I feel like, in the last 4 years after COVID that
Right.
I feel like we can't even
Oh, the
keep count
regulations
of
come.
everything.
Yeah.
Yeah.
Well, and they keep changing
Um,
their mind too. So,
100. Yeah, everything keeps changing, but I think the number one area we've seen is for business expenses is meals,
mhm.
entertainment, and the travel. From there on, I think it's depreciation of the fixed
Definitely.
assets. And are you taking the correct method of depreciation? Are you buying equipment just for shits and giggles, just to have that depreciation?
Right.
And, I can't think of what else I keep seeing
Auto is
most of.
huge.
Automobile. Oh my
Yeah.
gosh, yes. It's
We can
for
let's
another day.
no, let's talk a little
Um,
bit about the luxury autos because I think that's something that I get the most calls about definitely with my clients that are sole proprietors of their S corps or whatever it is, like sole shareholders. That's the call I get. Hey, what if I buy this car? Hey, what is this?
yeah.
So let's talk about that a little bit.
We're in LA again, entertainment capital, where everybody loves their luxury cars and showing off. They have a small LLC. They literally opened the LLC just to write off the car, get a
Right.
business deduction for it. There are rules around what you can depreciate with the car and which cars get full depreciation, which cars get 80%. So it's so crucial for you to discuss your purchase and how it's related to your business before purchasing the car. If you intend to take the depreciation but end up not being able to, and then it's a big cost on you. Um,
And I think we've seen too where the car like who actually owns the car. So I've had issues, not at RSJ, but at a previous firm where they purchased it individually and then never really transferred it to their business, but then the business is taking it and they're like, this is not how this is working. So we've had issues there as well.
yeah, for sure. And again, it goes back to your motives. What
Right.
were your motives from the beginning for your business or for that car or for any other equipment, large equipment you're buying?
I think that an area you talked about right now is fixed assets, and I want to touch on this before we run out of time because I think we have seen issues not only with IRS or your local or your state jurisdiction, but the local jurisdictions with fixed assets tend to be a really big red flag. So we could talk about that really quickly.
Right. Because California doesn't collect enough taxes. They also do business property tax statements due every May 15th. So you are required to report your assets that you carry in your business every year so that you can pay taxes on your property that you own for your business. Um, Not only do your assets get reported on your tax return with the depreciation, but you also report it to the county. again, with the interconnected government agencies, those two will chat and you will get a notice from one or the other saying, well, on your tax return, you have more assets than you do on your property tax statement because you're trying to avoid paying too much on the business property statements. Um, yeah, keep good records, I
Keep
think.
good records, yeah, and
Yeah.
talk to your CPAs, right? Really make sure that we're up to date as to what you're doing. And this kind of goes into our sale of assets and interest when you have a business. I think I just want to touch on this really quick. You know, the word basis has been thrown around a lot, and for good reason, because all of the jurisdictions are cracking down on basis requirements and reporting. So it's the same thing with these assets. And if you own an interest or as a business, as a partnership, or whatever vehicle you're using, if there's transfers and sales of your partnership interest between partners or new partners, those are being looked at because those then directly translate into the individual return. So the same way you're talking about your business assets, all of this kind of gets looked at a macro level and then gets really hypered into a micro level when it comes to collecting those taxes for what's there, what's not there most of the time.
Yeah, even like let's say with the business sale of your interest in that particular business, the business will file the tax return, report the sale, your social is on it, and you forget to do it, or you didn't know you had to report
Right.
it. It'll catch up because if one entity reports it and you don't, or one it's between two partners, it's between two individuals buying and selling a car, this person will report it and you don't, it'll be matching
Right. So again, we're
theory
looking at
again.
all of those. And I think I talked about this. I had a partnership who they transferred the interest to two separate people, and the IRS thing came back and was like, nope, like this is the income based off what was not transferred, even though we clearly filed the return and we said, hey, no, there was a transfer of interest. So again, keeping those records, like even if we do file a certain way and we do everything right, you still may have to provide those records and say, nope, this was a transfer. This is not the income belonging to that person. And again, that's where basis comes it's so crucial to make sure that we're keeping those records for basis, both for your fixed assets and for yourself, so any interest that you own. A couple of things, we're running almost out of time, so I just want to talk about this really quick. We touched on the automobiles. Could we touch on the automobiles that are in your business but you're using for yourself?
Um, sure. Just
Yeah,
really quickly, automobiles that you use part for business, part for um, yourself. It's again going back to the records of how much really, or like the mileage you're using to drive to and from meetings, to drive to and from clients, and to your work, and the miles you're using personally. I think for the most part, we use the mileage rule for our clients. For other clients, it's basically they've told us 80% of it is for my business because I am going from home to home selling X and Y. And then on the weekends, it's for personal use. So that can be broken down to percentage of use between business and personal. And
yeah, making sure, I guess you said
yeah.
the records. And there's two things I want to touch on. Um, Kendra was kind enough to remind me about the electric vehicle credits. Those are a huge area. Any type of solar, anything, those credits are looked at meticulously. So let's make sure that you're keeping your records. Before we close this out, for business income, I just want to touch on those 1099K again, because those are a little bit more new. For anyone that's listening, if you have a business and you have credit card, any type of credit card sales, whether that be through PayPal, through now Venmo coming up, your actual Square app, or your traditional credit cards, you will be receiving a 1099K. And if at the end of the year your 1099K is total more than what you're reporting in income, that is the hugest, biggest red flag you can have for a business. Don't do that.
I'm glad you touched on Venmo. I do get a lot of questions from my friends, their hairstylists, their nail salons. They're
Right.
they're so afraid of what's going to happen. But if you've been reporting your taxes as correct as you can to the best of your knowledge, and then now with the new rule, you're going to get the 1099K from Venmo. It's really not that big of a deal. It's gonna say you earned $6,000 this year from Venmo transactions.
Right.
And
It's the
you
same thing
just,
you've been
yeah,
doing before. And
exactly.
and the Venmo controversy too, I want to touch on that. there's two sides to it. One, again, it falls for business accounts originally. So if you have a business account, that's where it's going to affect you. The other side is if you are not using a business account for it, yes, that can then be looked for. And I think we've talked about this. The algorithms will pull, are you saying things for like, tip, thank you, great haircut, thank you for my nails, tip. If those are trigger words that are being used all the time, they're going to figure it out. Venmo has a reporting requirement as well. So kind of keeping that in mind as we go through. But Anna, I think we actually are out of time today.
We are out of time.
We are out of
And
time.
I think I saw a question come in. Will it be recorded? Yes, it is going to be recorded and it will be available shortly.
Yeah, so those all of our webinars are posted and available. And if you guys, anyone on this call has any further questions, always feel free to reach out. We are happy to help. We love doing this. Anna, thank you for a wonderful, wonderful time today. I appreciate your time and your effort.
Thank you guys.
All right, and we'll see you guys next month. Thank you so much.